Hi everybody, Ben here. Welcome back to the channel. And this one I'm going to give a brief introduction to Tenaz Energy, an oil and gas producer with a focus on offshore assets in the Netherlands. The company took an international level view of potential acquisitions and found a couple of orphaned natural gas assets that had a lot of upside growth potential located in the well-established infrastructure-rich area of offshore Netherlands. The natural gas prices are several times higher than Canadian natural gas prices as well. Tenaz now, with their two acquisitions in 2025, are the largest natural gas producer in the Netherlands. They also have a solid growing Canadian oil asset that makes up less than 10% of their production. The two Netherlands acquisitions were offshore assets called GEMS and NAM. NAM was a joint venture between Shell and Exxon that was really did not receive a lot of investment from these companies, as this asset is really just too small to move the needle for a super major oil company. GEMS was bought off a private equity firm and has a very high growth potential. The one well on GEMS has produced 75 million cubic feet of gas per day, making it the highest producing well in the Netherlands. There is also two discoveries that tested 50 and 20 million cubic feet per day, very strong potential at those wells. Tenaz also owns an equity stake in the three major pipelines and also gas plants in the area. The infrastructure has a lot of spare capacity, making it less capital intensive to add production. The company is projected to produce 21,000 barrels of oil equivalent per day in 2027, creating funds flow from operations of $310 million. The company has a net debt of around 362 million, which is very manageable and in line with industry standards. 16% of shares are held by directors and officers, so very strong insider ownership. The company is buying back 8.4% of the outstanding shares over the next 12 months, and the market cap is around 1.5 billion. These projections are from National Bank of Canada. On the left is the production growth. So you see the big jump in 26 from 25 up to, as I mentioned, 21,000 barrels. And then in 2027, another big jump in production to around 32,000 barrels. So this is all organic growth. This doesn't include any potential M&A, which the company is looking at. So in the middle is operating netbacks, and they are set, excuse me, to rise even if the natural gas price doesn't go up. And this is from just increased production, lowering the cost per unit from economies of scale. And on the right is the funds flow from operations. And it's going to be 310, as I mentioned, in 2026 estimate. And that's going to jump to 520 million in 2027. Another chart showing the number of prospective wells compared to what they have now in the Netherlands. So lots of growth opportunity on increasing the amount of wells. This is a chart of natural gas prices. AECO is on the bottom in Canada, and the red line is TTF. That is what Tenex is exposed to from their Netherlands operations. So very high gas prices with a company that is growing natural gas production very quickly. The management team is very experienced in Europe, coming over from Vermilion, and the stock is looking still undervalued here with 310 million in projected funds flow for 2026 and only a $1.5 billion market cap. I do own shares in Tenaz. Please do your own research on the stock and make your own financial decisions. Thanks for watching, and we'll see you in the next one.